Good morning, I'm Maiki Oreta, and you're watching Business 360, where we break down the numbers, connect the dots, and give you the developments and the insights you need to navigate, adapt, and lead. Let's dive right in. The country's debt service burden climbs to nearly $6 billion in the first 5 months, putting more pressure on government finances. The Finance Department aims to raise over 193 billion pesos from the privatization of nearly a dozen assets, including prime land and strategic holdings. And Malacañang removes Philippine National Police Chief General Nicolas Torre III in a shakeup of leadership at the 228,000-strong police force. All that and more coming up. First, let's take a look at how global financial markets moved overnight. Wall Street closed lower, snapping Friday's rally after Fed Chair Jerome Powell said a September rate cut is possible, but not guaranteed. Speaking at the Jackson Hole Symposium, Powell flagged a weakening labor market as a key factor in the Fed's next decision. Investors are now watching both central bank signals and big tech earnings to gauge market direction heading into September, a crucial month for policy and trading volumes.
I think there's a lot of news that's being digested. It started last weekend with excitement over Chairman Powell's comments at Jackson Hole, but now that's being digested, and that rate cut in many ways was already in the market. And so I think the market's really focusing on a bunch of new news, investments by the government and companies directly, and NVIDIA's earnings yet to come.
The Dow Jones Industrial Average fell 0.8%. The S&P 500 slipped 0.4%, ahead of NVIDIA's highly anticipated earnings. And the Nasdaq eased 0.2%. In Europe, stocks also closed lower. Germany's DAX lost 0.4%. France's CAC 40 dropped 1.6%, while London's FTSE was closed for the summer bank holiday. Global volatility remains in focus, with Fed policy shifts likely to influence the peso, BSP decisions, and investor flows into emerging markets like ours. Here at home, our debt service burden rose to $5.9 billion in the first 5 months of the year, putting more pressure on government finances. Data from the Bangko Sentral ng Pilipinas shows this is slightly higher than the $5.8 billion recorded in the same period last year. The BSP explains that the figure covers principal and interest payments on fixed, medium, and long-term loans, including borrowings from the IMF, Paris Club creditors, commercial banks under rescheduling, and new money facilities. The larger debt service bill underscores the delicate balancing act for government funding, development, and infrastructure, while keeping the country's fiscal health credible to investors. The Finance Department is moving to tighten control over public funds, ordering state agencies and corporations to channel their capital market investments through government banks. The move is aimed at boosting income opportunities for the national government. Under Department Circular Number 001-2025, Finance Secretary Ralph Recto directed that investments in bonds and equities be made through state-run banks acting as underwriters, book runners, or selling agents. The order covers national agencies, GOCCs, GFIS, and similar entities. Provident and retirement funds are also encouraged to comply, except SSS, GSIS, and Pag-ibig. If no state bank is involved in an issuance, agencies must request one be included or secure a certification from arrangers and submit it to the DOF. The directive strengthens the role of government banks in capital markets, centralizing fund flows at a time of heavy borrowing and tight budget pressure. Now we have this breaking news. Malacañang has removed Philippine National Police Chief General Nicolas Torre III in a major shakeup of the country's police leadership. In a letter signed by Executive Secretary Lucas Bersamin, Torre was directed to immediately step down and ensure proper turnover of his office. The letter did not cite a reason. But the move comes just weeks after Torre's rift with Interior Secretary Juanito Victor Remulla over the reassignment of senior police officials, including the relief of Lieutenant General Jose Melencio Nartates as PNP Deputy Chief for Administration. Police Major General Jose Melicio Nartates Jr. is now set to take over as the country's new top cop. The sudden leadership change raises questions over stability and accountability within the Philippines' 228,000-strong police force, a key institution for law and order and business confidence. The Department of Finance is looking to raise over 193 billion pesos through the privatization of nearly a dozen government assets. The list includes the financial center area in Pasay City, estimated at 53.5 billion pesos, and the food terminal property in Taguig, valued at 40.4 billion pesos. Also up for sale, the Ecology Villages 1, 2, and 3 in Makati City, worth a combined 13.61 billion pesos. The government is also eyeing to divest shares in several companies, including South Luzon Expressway Corporation, as well as Semirara Mining and Power Corporation. Analysts say the target is realistic, but they warn that privatization should not be seen as a silver bullet for the country's fiscal problems. The push comes as Manila struggles to narrow its budget deficit and boost investor confidence, with asset sales part of a broader strategy to shore up public finances. Stronger Filipino purchasing power is spurring a new wave of economic zone projects, this time aimed at the domestic market, not just exports. Philippine Economic Zone Authority Director General Teresa Panga says 12 mayors from different LGUs have expressed interest in new eco zones, mostly focused on manufacturing and agro-processing. These initiatives, backed by private developers and local governments, include high-value projects such as steel manufacturing and power plants. New zones are expected to strengthen regional economies, particularly through better port connectivity. Panga stressed that economic zones have proven to be engines of growth, bringing in more investments, creating jobs, and expanding the tax base for local government. The Philippine Coast Guard has disenrolled Global Ferronickel Chairman Joseph C. from its auxiliary executive squadron after allegations of citizenship misrepresentation. The decision follows verified reports that C falsified his citizenship, a serious breach of PCG values. C had been appointed to the auxiliary squadron in 2018 and held the honorary rank of auxiliary commodore. The Bureau of Immigration has taken him into custody over alleged fraudulent Philippine IDs. Meanwhile, mining companies defended him, claiming his citizenship had been affirmed twice. Bilyonaryo Joseph C. is a Filipino citizen, that's according to Global Ferronickel Holdings Incorporated, following C's detention over allegations of overstaying as a foreigner. The company says C's citizenship has been confirmed by several government agencies, including the Bureau of Immigration, Department of Justice, Office of the President, SEC, and the Supreme Court. It adds that C presented his valid Philippine passport, the official proof of Filipino nationality under the law. In other news, the lifestyles of government contractors are now under the microscope as the Bureau of Customs launches a probe into dozens of luxury cars owned by couple Sara and Curly Discaya. The Discayas are reportedly behind Alpha and Omega General Contractor, one of the 15 firms identified by President Marcos as having cornered the most number of the country's flood control projects. Customs Commissioner Ariel Nepomuceno says that the trigger was media interviews where the couple showed off their luxury vehicles. But the customs chief also clarified they would need a court order to launch any operation inside the Discaya's private residence. The case highlights how anti-corruption probes are widening beyond projects themselves to the contractors profiting from them. We're taking a quick break. Please stay with us as we dive deep into the numbers and the narratives that matter most to your bottom line. Welcome back. Let's check on how Asian markets are moving this Tuesday morning. Right now, the Nikkei 225 is in the red, down by 1%. Hong Kong's Hang Seng Index down as well, down by 0.3%. Shanghai Composite down by 0.3%. And Singapore Straits Times Index down by 0.4%. As it appears following the losses in Wall Street overnight. Here at home, the Philippine Stock Exchange was closed yesterday for the National Heroes holiday, and it reopens trading today after the long weekend. Global markets are still digesting signals from the U.S. Federal Reserve's Jackson Hole Symposium, a policy event closely watched by investors. Fed Chair Jerome Powell said rate cuts could come in the months ahead, but warned that they will be data-driven and cautious. He also flagged that new tariffs are pushing prices higher while core inflation remains sticky and hiring shows signs of weakness. Here at home, the Bangko Sentral is in the middle of an easing cycle with the Monetary Board meeting again on Thursday. Markets expect another 25 basis point cut with one more possible before the year end. Another round of BSP easing alongside expectations of Fed action is seen as a catalyst to lift investor sentiment and support equities heading into the final quarter. Taking a look at the main gauge this morning as of 10:19, we are seeing weakness. The main gauge is in the red, lower by 0.7% to 63.39. The broader all shares index in the red as well, down by 0.5% to 37.20. As for the sub-indices, everything is in the red except for the mining and oil counter bucking the market's current downtrend with a gain of 0.9%. Total volume traded is at 313 million shares valued at 1.22 billion pesos. Market breadth is negative. We've got 77 decliners, 69 advancers, while 40 stocks remain unchanged. A new report shows the Philippines is getting the worst bang for its buck on tourism investments in Southeast Asia, earning just 57 cents for every dollar spent. According to investment and hedge fund manager Eric Jurado, the government poured over 1.32 trillion pesos into tourism infrastructure and promotions, but the country generated only 750 billion pesos in tourism revenue in 2024. By comparison, Vietnam delivered the highest return, nearly $2 for every dollar invested. Jurado said that the Philippines' poor performance stems from inadequate infrastructure, weak branding, restrictive visas, and underused data. He recommends a complete reboot, stronger infrastructure, a fresh branding push, and looser visa rules to compete regionally. Tourism is a key pillar of our economy, but these numbers show a widening gap between government spending and actual returns, underscoring the urgency for reforms. Now, the Bangko Sentral ng Pilipinas meets this Thursday, August 28th, to decide on monetary policy. That's just 2 days from now. Markets are expecting a 25 basis point rate cut, with another possible before the end of the year for a total of 50 basis points in the second half. Inflation is at a 6-year low of 0.9%. Growth has been sluggish and global uncertainty looms, making this a crucial decision for businesses and investors. Joining us now is Angelo Taninco, the Chief Economist of Security Bank and former Assistant Secretary at the Department of Trade and Industry, to break down the outlook for policy easing and what it means for our economy. Hi, Jello. Thank you for being here with us.
Thank you for being here.
So we're at a crucial junction. 2 days from now, the BSP is going to talk about monetary policy. Growth in the second half was moderate at 5.4% for the period. How would you describe the state of the Philippine economy as we head into this crucial rate meeting?
Yes, in the first half of 2025, the Philippine economic growth was still at sub 6%, but it averaged about 5.4%. There were some sectors that grew strongly, such as agriculture, but also those that have fared sluggishly, like manufacturing and even construction, particularly in the second quarter. So the growth trajectory appears to be tilting slightly downward, meaning to say a moderation of growth. And that is kind of expected because of the higher uncertainty that was injected from the external sector, particularly on the higher tariffs. For the second half, we are still expecting monetary accommodation. Later this week, the BSP is widely expected to cut the policy rate by another 25 basis points in order for the policy rate to settle at 5%. And therefore, there's a total of 3 rate cuts equivalent to 75 basis points. And that will help inject more demand into the economy and help spearhead the economic trajectory.
3 rate cuts, you said. 3 rate cuts. Are you expecting 3 rate cuts the second half?
This second half, we are expecting, aside from the August 28,
Okay,
another one
you're
in December.
that. Okay.
Yeah, so for the full year, we're looking at a total of 4 rate cuts.
All right. Your outlook for GDP growth, your full year outlook is at 5.6%, your house view. Can you describe what kind of, so still modest growth this second half?
Yes, we are looking at 5.8% GDP growth for the second half. That's partly because of low base effects. In the second half of last year, it was about 5.2 to 5.3%. However, this third quarter alone, it seems that there is more downside risk to our outlook, primarily because we have lots of tropical storms in July, and also the current situation that resulted in work suspensions, and that's hampering economic activity for the third quarter.
Okay, just to get those figures right, you're expecting from 5.4% in the first half. You're expecting 5.8% in the second half for a full year of 5.6%.
Yes.
Okay. Baby steps with the rate cuts in the Philippines, here in the Philippines. That coupled with Fed Chair Jerome Powell, should they cut interest rates? His speech at Jackson Hole, he was pretty dovish. But when it comes to interest rates, how do you think that's going to play out? Do you think the Fed is going to cut? And if they cut interest rates, what's that going to mean for us, Jello?
For the September Fed meeting, we are looking at a 25 basis point hawkish cut. The rationale behind a hawkish cut is because despite the labor market facing downside risks, and we have highlighted that in the July data, we think that the upside risk to U.S. inflation is still equally important, particularly because of the higher U.S. tariffs. And therefore, we think that the Fed ought to have an insurance type of cut for September and then pause in their next meeting before resuming with another 25 basis point cut in December for a total of 50 bips worth of cuts for the remainder of the year. But we also believe that the Fed will not stop there. It will continue to ease monetary policy because it's still currently restrictive. And they want to move it towards a neutral level so that the labor market in the U.S. will not struggle in light of the higher tariffs, but at the same time contain inflation expectation, which could go up if the tariff rates will continue to be persistently high.
So many moving parts. It's not very simple.
Yes.
But cutting the rates in the U.S., the Fed, even a 25 bip cut, would bring down the interest rate differential between the U.S. and the Philippines to new record lows. What does this mean for us?
Well, as the BSP cut rates on August 28, the interest rates differential will narrow further from the current 75 basis points to a new record low of 50 basis points, which we think will stoke some peso depreciation pressure. However, the Fed, we expect to cut rates also in September. And with the two central banks expected to cut rates last time for the year in December, so this will bring back the interest rates differential at 75 basis points, which we think is healthy or manageable in light of the current economic conditions, both in the U.S. and in the Philippines.
Yeah. That said, what's your year-end outlook for the peso?
We are still pegged at 57 flat for the dollar peso. So in this third quarter, we expect the peso to depreciate in light of a narrower rates differential and then resume its appreciation track, usually in the fourth quarter because of holiday-related inflows.
Okay. We also want to leverage on your trade experience, Jello. You were the former Assistant Secretary at the DTI. The Philippines is running a large trade deficit of over $70 billion, or nearly $4 trillion this year, and that's projected to widen further. We're always an import-dependent nation, so we will always have that deficit. But what are your thoughts of it at these levels?
It will be good for the Philippines to forge more bilateral free trade agreements, such as that with the EU, which is the fifth largest trading partner of the Philippines. This is because the Philippines has the fewest, or one of the fewest, bilateral FTAs in the world, especially within our Asia-Pacific region. So having more FTAs will help boost our exports because this will provide greater market access for our goods, and even harness more foreign investments because this will open up our domestic markets for foreign players, and therefore trade and investment flows between the Philippines and with those potential partners such as the EU will be spearheaded, and therefore this will create more job opportunities for us. Technology transfer will also be encouraged, and therefore this will help propel our growth trajectory, not just for the medium term, but more importantly for the long term.
We need to look to them so the growth keeps on going. The EU is a huge market, and it's an important alternative given everything that's happening with the United States. How critical is this FTA with the European Union in terms of offsetting the headwinds from the U.S.?
Well, I think it's very important because as our exporters face higher tariffs in the U.S., then they need to have alternative markets that are big enough that can accommodate their supply of goods. And even in the services side, because we now see a potential risk coming from the U.S. in light of the BPO sector, we also would like to have more market access for the Philippine service providers, such as also in the EU. And therefore, this will rebalance our trade and investment ties, say less from the US and more towards other markets such as the European Union.
As we look to this, as we pivot, do you think that growth this second half can outpace the trade risks?
Especially for the 2026, because as we continue the rate cuts, this will provide more monetary easing, and that will help stimulate domestic demand. And this can be felt more next year because of a low rates environment, and given manageable inflation,
very manageable inflation,
at say within the target range, close to the midpoint based on our forecast, then we believe the economic growth of the country will be better next year as opposed to this year. And there's going to be more clarity on the uncertainties because we now see that the tariff rate of the US on the Philippines is now at 19%. So with that, businesses can decide more on how to navigate that type of headwind. And in order for them to continue to invest and be able to reap.
And what do you think this better environment will mean for our capital markets, for equities, for bonds and fixed income?
Well, investors can also better navigate as it gets more clarity on the tariff rates from the US and also from the interest rates because of the ongoing monetary easing. And this will help the capital markets prosper, especially for next year. We are seeing more upside on, let's say, local stock market and even the local bond market, which has been benefiting already from the rate cuts.
So,
and we think that the next would be the stock market as we continue to also help uplift our economic growth trajectory. So as we improve our growth for next year with manageable economic environment such as inflation low and interest rates also low, then we expect the investors to continue to invest more into the local capital markets, and that will be also partly based on a better growth outlook.
Yeah, a lot of that is hinged on the U.S. Another thing we're watching in the United States is the independence of the U.S. Federal Reserve from the White House. What are your thoughts on this, on the dynamic between Trump and Fed Chair Jerome Powell?
So the market is closely watching the Fed independence and how the Fed relates to the White House. So I think over the medium term, that will be a sort of a challenge for the U.S. Central Bank on how to convince investors that it is still independent. We saw that when the U.S. President Trump let go Fed Governor Cook this morning, the U.S. dollar dropped. So we see the reaction to the U.S. dollar that it is slumping because of such action. And therefore, this could bode well for emerging market assets as we continue to see the struggles of the U.S. dollar in light of these kinds of events. Then EMs will likely benefit from it, including the Philippines.
Okay, well, a lot to watch out for. Here at home, I wanted to ask your thoughts on this. The president in his SONA vowed to crack down on corruption, particularly in infrastructure, and he's doing just that. From a business and economic perspective, Jello, what are your thoughts on how corruption in infrastructure affects our growth story?
Well, it is a dampener. Corruption is a dampener. I mean, worldwide, we see that countries with low corruption tends to perform better than those with high corruption. So it seems that the president is doing a good thing when it comes to addressing corruption, especially in big projects such as in infrastructure. And given that, investors will react positively because this means that the governance aspect, not just on the public but also on the private side, is being addressed and therefore being improved. And therefore, we think this can help improve also the market sentiment of investors.
Yeah, corruption, it's like a hidden tax that we shouldn't have to pay. All right, Jello, thank you so much for sharing your thoughts with us on the markets and direction of our economy and more.
Thank you.
All right, we're taking a short break. Business 360 will be right back. Welcome back. A crackdown is underway in the fast-growing digital lending space as the Securities and Exchange Commission orders 7 unregistered platforms to immediately halt operations. The cease and desist orders cover Cash Connect, Peso Suki, Yescom Lending, Peso 101, Peso Cow, Swift Loan, and Pera Loan, all found to be operating without proper registration. The SEC warned these companies violate regulatory guidelines and put borrowers at risk from abusive collection practices to possible data privacy breaches. The move is part of a wider push to clean up the online lending industry and restore trust, especially as more Filipinos turn to digital credit amid rising consumer spending. Now, one of the country's biggest liquor brands is showing resilient demand as Tanduay Distillers' net income surged to 1.36 billion pesos in the first half of the year. That's nearly double the 712 million pesos it reported in the same period last year. The liquor and spirits arm of LT Group says the jump was driven by higher revenues, better margins, and market gains. Now, the results show how consumer spending on lifestyle and leisure remains resilient even amid moderate economic growth. Now, All Home Corporation's profits have taken a big hit, with net income dropping to 71.76 million pesos in the second quarter. The Bilyonaryo Villar-led retailer says that's nearly 50% lower than the 142.1 million pesos it posted in the same period last year. All Home blamed slower sales amid a subdued property market and tougher competition in the home improvement space. The results highlight how retailers tied to real estate activity remain under pressure, with property demand still soft and consumers more guarded in big-ticket spending. On another front, the Konektadong Pinoy Act has now lapsed into law, promising cheaper, faster, and more reliable internet by opening the market to more players and driving competition. DICT Secretary Henry Aguda says the law will lay the foundation for universal connectivity, making internet access more affordable and accessible to all Filipinos. Converge CEO Dennis Uy welcomed the move, but stressed that strong regulatory rules are crucial to prevent substandard services and to ensure a level playing field. Telco giants PLDT and Globe, however, have raised concerns about the law's impact on existing operators, particularly the need to maintain regulatory balance. Aguda also revealed that over 24 new providers, mostly from the United States, have already expressed interest in entering the Philippine market. The new law marks a turning point for the internet industry, seen as a critical utility for businesses, schools, and communities in a digital economy. We're taking a short break. Business 360 will be right back. Welcome back. South Korean President Lee Jae-myung says his country will strengthen its alliance with the United States. He made this statement after meeting with President Donald Trump at the White House on Monday. The two leaders also agreed to work together on the denuclearization of the Korean Peninsula.
At a summit meeting today with President Trump and I agreed to make our own and modernize our bilateral alliance to be more reciprocal and future-oriented, in line with a changing security landscape. The U.S. defense commitment to the Republic of Korea and our joint defense posture remain unwavering and ironclad. At the same time, Korea will take a more leading role in maintaining security on the Korean Peninsula.
President Trump, for his part, expressed optimism that a new trade agreement with Seoul could be reached soon, a deal seen to have wide implications for regional markets and supply chains.
Yeah, I think we have a deal done. They had some problems with it, but we stuck to our guns. We are going to, they're going to make the deal that they agreed to make. And he's a very good guy, a very good representative for South Korea. It's a very big trade deal. You know, it's the biggest deal they've ever made by far, but it's one of the biggest deals ever made. The biggest deal ever made is the one with the European nations, as you know. The Europe deal is the biggest deal ever made.
U.S. President Donald Trump is turning up the heat on Beijing, announcing a 200% tariff on China's magnet exports to the United States. Trump acknowledged the move could have serious consequences for Washington's trade relations with Beijing. China has long been protective of its rare earth supply, adding magnets and other items to its export restriction list last April in retaliation for earlier U.S. tariff hikes. Earlier this month, the two sides agreed to extend for another 90 days a pause on further tariff increases.
But we have a very strong relationship, Howard, I would say, economically with China now, getting much better. They have to give us magnets. If they don't give us magnets, then we have to charge them 200% tariff or something, you know. But we're not going to have a problem, I don't think, with that. I think that's perhaps behind us. You know, China intelligently went and they sort of took a monopoly of the world's magnets. And nobody needed magnets until they convinced everybody 20 years ago, let's all do magnets.
The rare earth clash matters well beyond the U.S. and China, since these materials power electronics, vehicles, and clean energy supply chains across Asia, including here in the Philippines. U.S. President Donald Trump says he wants to pour more money into healthy American companies, starting with chipmaker Intel. The move marks a major shift from the decades-old approach in which the U.S. government only took corporate stakes during crises, such as the 2008 global financial meltdown. The White House recently announced a near 10% stake in Intel, converting government grants into an equity share.
But I said, I'd like you to give 10% of Intel to the United States of America. Not to me, to the United States of America. And I said, if you have them as a partner, you have the United States as a partner, I think that would be a very good thing for Intel. And he thought about it, a little bit different, and he said, I like that idea very much. We have a deal. And I just made $10 billion or $11 billion for the United States of America. And yeah, there will be other cases. If I have that opportunity again, I would do that.
On another front, Illinois Governor J.B. Pritzker is branding as illegal President Donald Trump's plan to deploy U.S. soldiers to Chicago. Trump justified the move by citing reported lawlessness in the city, similar to his earlier decision to deploy National Guard troops in Washington. But Pritzker stressed that Illinois made no request for federal intervention, while the state's Attorney General warned legal action would be taken to block any federal deployment in Chicago.
Over the weekend, we learned from the media that Donald Trump has been planning for quite a while now to deploy armed military personnel to the streets of Chicago. This is exactly the type of overreach that our country's founders warned against. And it's the reason that they established a federal system with a separation of powers built on checks and balances. What President Trump is doing is unprecedented and unwarranted. It is illegal. It is unconstitutional.
And that's it for Business 360. I'm Maiki Oreta. Thank you for joining us, and keep it here on BNC, the Bilyonaryo News Channel.